Have you ever wondered why on the stock market there are leveraged 2x and 3x ETF built on indices or popular stocks? To me, they look like a trap. I don't use those products, and if you take investing seriously, you shouldn't either. What they promise and what they really deliver. They shout double returns, triple returns. You think, great, the market goes up. I apply leverage, I make 2 or 3 times more. But reality is brutal. Research shows that a typical 2x leveraged ETF over 10 years may only amplify the underlying index by amount 1.4x or 2x. Meanwhile, your risk is doubled or tripled. In other words, you don't just get twice the chance, you get twice the risk. Why they are harmful and pointless? First, volatility drug, sometimes called variance drain. In choppy markets, leveraged ETFs start to stall. You might even lose money while the underlying index is up. I call it hidden cost of volatility drug. Second, the promise mismatch. Some leveraged ETFs advertise 2x returns, but actual performance lacks. For example, one 2x fund delivered around 1.5% per year versus 8% on the benchmark index. Third, they are not built for long-term holding. These funds are designed to reset daily. If you hold beyond a day, week, or month, your results almost always degrade. Fourth, institutions avoid them too. Studies show that entities holding leveraged ETFs often perform worse over time compared to those who never hold them. When you invest in companies, you become part of their growth. When you buy leveraged ETF, you join the casino. Leveraged ETFs aren't growth tools. They are risk amplifiers. They lure you with flashy multipliers. But over time, they tend to bleed wilder. If you want financial freedom, don't bet, invest. Be part of real business growth, not part of leveraged machinery chasing short-term spikes.